This is one of the rarest patterns on a chart and one of the most overlooked because it hides inside what looks like pure chaos. But when you learn to see it, it often hands you something valuable, a warning that a trend is about to end. It's called the diamond, and it's really two patterns stitched into one. Let me show you how to spot it and how to trade it. Let's start with the diamond top, the most common version, the one that forms after a strong uptrend. Here's the twist that makes it special. It's built in two stages. First, price broadens out. The swings get wilder, higher highs and lower lows. The range expanding like the market is losing control. Then it does the opposite. The swings start shrinking, lower highs and higher lows, the range squeezing back in toward a point. Now connect those highs and lows. The expanding half and the contracting half together draw the shape of a diamond. Here's the story behind it, and it's the whole key. That first half, the broadening, is panic and greed at their loudest. After a long climb, buyers and sellers are battling violently, swinging price around, and that chaos is a sign the trend is exhausted. Then the second half, the contracting, is the storm burning itself out. The energy compresses, the swings die down, the market coils tight. And when a coiled market finally snaps, it usually breaks against the trend that came before it. So after an uptrend, it breaks down. Now how to trade it? 3 simple steps. Step 1. Your entry. You do not sell while price is still inside the diamond. You wait for the breakdown. The moment a candle closes below the lower line of that second contracting half. And it's far more convincing if it breaks on a spike in volume, because that means sellers are taking over for real. Step 2. Your target, how far it could go. You measure the height of the diamond at its widest point, the tallest part right through the middle, from the highest high down to the lowest low. Let's say that's $10 tall. Now subtract that height from the breakdown point. If price breaks down at 52, then 52 minus 10 gives you a target of $42. Step 3. Your stop loss. You place it just above the last high inside the diamond, back up inside that contracting half around 56. The logic is clean. If price breaks down but then climbs back up into the diamond and pushes past that high, the pattern has failed and you're out with a small controlled loss. And one tip to sharpen your eye: volume. The diamond has a signature volume story. Loud during the wild broadening phase, then fading as the swings contract, and then surging again on the breakdown. That fade then surge is your confirmation. It's the real thing. Now the mirror image, the diamond bottom. Flip everything. Same diamond shape, broadening then contracting. But this one forms after a downtrend. The market goes wild, then coils, then snaps the other way. It breaks up through the upper line. You trade it the same way, just in reverse. You wait for the break above, you measure the diamond's height, and project it upward for your target. And your stop goes just below the last low. So remember the simple rule: a diamond reverses the trend that came before it. After an uptrend, it tends to break down. After a downtrend, it tends to break up. Now the honest truth, like with every pattern, this is not a guarantee. It's an edge, the odds tilted in your favor. You wait for the break, you set your stop on the far side, and you let it run toward target. So there it is, the diamond. A broadening half and a contracting half, drawn into one shape. It reverses the trend before it, and your target equals the height of the diamond. Spot it, wait for the break, and trade it with a plan. I'll see you in the next lesson.